U.S. natural gas prices climbed to a two-week high, supported, as some analysts suggest, by a colder weather outlook and strong LNG export flows. Let's be honest, the so-called bullish fundamentals behind this latest rally look about as convincing as a warm winter forecast in January. Yes, the models show a slightly cooler trend for the next 2 weeks, and sure, LNG flows have ticked up to around 16.5 billion cubic feet per day, up from 15.7 in September. But with storage still 4% above the 5-year average and production barely dipping, it's hard to argue that this sudden enthusiasm is rooted in fundamentals. Instead, the price action seems to have more to do with geopolitics and trader sentiment than with any real supply crunch. Europe's ongoing energy chess game and lingering uncertainty around Russian gas have likely done more to lift prices than the weather maps ever could. We're also only about 7 days away from rolling into the December contract, the classic should-be bullish period, and traders are clearly positioning for that. So, while the narrative is dressed up with colder weather and strong exports, the underlying story feels more like speculative momentum with a geopolitical twist. Fundamentals are tagging along for the ride but hardly in the driver's seat. In summary, the setup is fundamentally shaky but technically charged. The next few sessions will likely determine whether this is just another weather and hype rally or the start of a genuine breakout. Either way, the market seems ready to test its limits as we head into the December contract, with $3.80 and $4 in sight if momentum keeps feeding itself. From a technical perspective, natural gas futures remain in short-term bullish territory. Prices have been pressing against resistance around $3.55, and if that level breaks decisively, the rally could turn impulsive, potentially testing $3.80 and even $4 next. Momentum indicators such as RSI still point upward, though RSI is approaching overbought levels, hinting that a pullback wouldn't be surprising. The $3.20 to $3.40 area remains a key support zone, while the 50-day moving average near $3.05 marks deeper support if the market retraces. Volatility remains elevated, and with the contract rollover approaching, traders should brace for sharp swings. The technical outlook suggests that sentiment, not fundamentals, is driving the show, and if the $3.55 barrier breaks, the next leg up could come fast and loud. Otherwise, the current price spike may be short-lived, with a sharp pullback likely toward the $3.05 support. Don't forget to drop a comment, check out the last video and support the channel. Catch you in the next one.